Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. I'm pleased today to welcome a new guest, Jeffrey Huge, who's the CIO of JWH Investment Partners, a private family office, and the founder of Alpha Insights, an investment strategy and advisor service for investment professionals. Jeffrey, thank you for joining Sprott Radio today.
Great to be here, Ed.
Well, I know when we were prepping for today's podcast a bit, you want me to ask very specific questions, but I'm going to break the rule right out of the gate here and talk a little bit about yourself. So if you could just tell our listeners, Jeff, a little bit about yourself, kind of where you're based out of, because we just met literally last week in Minneapolis, and I know you're kind of based in that area. Talk a little bit about JWH Investment Partners, as well as, Alpha Insights and what that is. But let's start with you first. Give us a bit about your background and how you got into this business to begin with.
Absolutely. So first of all, I'm based in Minneapolis, Minnesota, and it was nice to meet you at the Titan Investors Conference last week. It was a great event. I've been in Minneapolis my whole career, although I've worked for the big Wall Street firms. So I started in the business back in 1990, working at a local firm in town called Piper Jaffray, where I was just there for a couple of years, and I was recruited by one of the big Wall Street investment banks, Merrill Lynch at the time, which had a large presence in the Twin Cities, one of the largest regional offices in the country for Merrill Lynch, run by a guy named Dave Patton. And Dave hired me to be an institutional salesman. This was something I did for about 24 years. I was at Merrill until 1999. I left and was recruited to go to work for, at the time, Solomon Smith Barney, where I basically did the same thing. And I built an office for Solomon Smith Barney in the Twin Cities. Later, the name changed to Citigroup Global Markets, so people would know that as Citigroup today. I started a family office, and that family office is JWH Investment Partners, and it's basically house capital. We don't take outside money. But, I would get so many calls and so many inquiries from former colleagues, former clients, asking me, hey, Jeff, what are you doing in your own account? What are you trading? What do you like right now? And there were so many, Ed, I couldn't field the questions. So I started to publish like a 10-page chart book. These were my top 10 ideas of the week. And then, I'd be sending that out to 10, 20, 100, 200. Got to be like 4,000 people were getting it. It grew from 10 pages to 50 to 100 pages. And now I've kind of consolidated it down into a real business. And that was a function of somebody sending me a check one day. I didn't even realize I was in the research business, but one day somebody said, hey, we want to subscribe to Alpha Insights. How much do you charge? I'm like, how much you got? He's like, well, we want to start you with X and we're going to send you a check. I'm like, okay, that'll do. So, I realized I was in the research business at that time, and I kind of formalized the product. And that was 8 years ago when I launched it. And so, we've been publishing a monthly piece called Huge Insights, The Big Picture, which has become a Substack newsletter. And that's a very popular Substack right now. We've got some 6,700 subscribers to that. It can be found on Substack at hugeinsights.substack.com. Alpha Insights remains kind of our primary institutional product that's really designed for hedge funds, long-short hedge funds, global macro hedge funds that are looking for big picture ideas and long-short ideas within the S&P 1500. So we look at small cap, mid cap, large cap stock universe. We publish every single week our Alpha Insights weekly playbook, where we do some market analysis across all three of those areas of market cap. We publish our top 5 longs and our top 5 shorts, and a few, macro ideas within there as well. And we do a lot of sector rotation work and a lot of valuation work. And this goes out every Sunday night to a bunch of institutional clients that we've been servicing for, the better part of the last decade. And, then every quarter we do something called our review and outlook. And it's a big 100-page document that kind of looks at all sorts of macroeconomic models that we've developed and looks at wide variety of different equity market indicators, fixed income market indicators, and looks back at the past quarter for performance and projects an outlook. That's basically the product. It's a research product. It's kind of a sidecar to our family office business. And, there's a group of us that work on it as kind of a full-time gig. And, I kind of float back and forth between the research business and the family office business.
Mm-hmm. So what are some of the key macro drivers right now, or things that you're seeing as macro drivers that investors should be thinking about or looking out for?
Ed, the single factor that overlies everything, that underscores everything that we're doing in our work today is the US dollar. And
Okay.
we think that the US dollar is at the precipice of another major structural bear market that we think could extend for years, if not decades. And what we've done is we've looked back at the history of the US dollar as a gold backed currency and a fiat currency. And we've noticed this pattern, this cycle that exists. And that cycle began in 1972 when Nixon took us off the gold standard and began the first structural decline in the US dollar. And the US dollar index is, it only goes back to about 1970. So we've got pretty good history, about 55 years or so of history, but we can infer what happened prior to that. And what we see is the US dollar index tends to kind of trade down to about 75% of its par value relative to this other basket of currencies, right? And that basket has changed over time with the advent of the euro. But we saw the cycle kind of reverse as we got toward that 75 level back around the early 80s or so, when it rallied aggressively to a lower high in 1985. And that's when the Plaza Accord came out. That was the next catalyst that kind of drove a structural bear market that lasted really from 1985 into the early 2000s area. And then we saw kind of this rally again in the US dollar up to a lower high as Greenspan initiated what I would describe as an era of financial repression. An era by which he collapsed interest rates down to 1%, and subsequently they went even lower. And this is what really turned the market again, where the dollar peaked again at a lower high and then collapsed back down into that 75 area. And that was around roughly 2011-ish. And we rallied off that into a new high last December, about 110 or so on the US dollar index. And from that level, we've come down to a low of around 96. 96 level is pretty important because it kind of intercedes or coincides with the trend line off the prior lows, that 2011 low and another 2021 low, and also the 10-year moving average, as well as some other chart support levels. And the breach of that 97, 96 level now opens up the potential for the dollar to make a new structural bear market trend. Our work suggests that over the next, say, 3 to 5, possibly even 10 years, we could see the dollar under sustained pressure down to around 75. And, my suspicion is it's going to happen sooner rather than later.
What do you think's driving that? Is it a combination maybe, or is it one or the other of the economic world is getting bigger? Other parts of the world are starting to have more of a say than maybe they had in the past. Or are we kind of shrinking? Are we contracting as far as our relevance to the global economy? What do you think's driving this kind of slow, perpetual slide?
Let me start at a slightly higher level than that, and then we'll come to that. At a very high level, where it really begins is that the U.S. debt to GDP has ballooned dramatically, okay? And it's reached what I believe we could qualify as a tipping point right now. We are above 120% debt to GDP. We've been as high as 125% in recent quarters. And in my opinion, at that level, it's just absolutely unsustainable. And, the other thing that's contributing to this is this perpetual deficit. We've been running 6 to 7% budget deficits at the federal level. And this is during presumably good economic times where, we're experiencing GDP growth, low unemployment, all systems go, right? If you listen to the current administration discuss the condition of the economy, they would have you believe we're in the greatest economy that the world has ever known, right? And so if that's the case, why are we running this persistent 6 to 7% budget deficit and building up this debt? And so I'm not the only one asking the question. The rest of the world is asking that question too. And they're saying to themselves, is the dollar really the safest place for me to go? Is it the place that we really want our reserve assets huddled around, right? And a number of countries have seen the U.S. used the US dollar as a weapon, right? We've weaponized our currency because of its reserve status. And, we've used that as a way to put sanctions on other bad actors in the economy. What's happened is many of these countries have basically said we're going to shift a large portion or a much larger portion of our central bank reserves into an asset that we believe is universally accepted and stable and safe. And that asset has become gold bullion. And so what we've seen over the course of the last 25 years, and this has actually been going on slowly, gradually, and things happen gradually and then suddenly, right? As Hemingway once wrote. And the media has just picked up on it in the last couple of years, right? That this is happening, but it's been happening. In fact, foreign central bank reserves have doubled from around 10% on average 25 years ago to about 22% today. And in fact, they are now higher as a percent of central bank reserves than US Treasuries are. Slightly. It's kind of flipped, right? Our suspicion is that that trend is now structurally ingrained, and it hasn't hit a peak and is ready to roll over. It's accelerating. And I think the next step will be for central bank reserves to grow from 20% to 40% over the next 25 years. And that, to me, puts a fundamental floor under the price of gold. And so gold will become the default reserve asset for foreign central banks over time.
I think people are always surprised when you look at the return patterns of let's just say gold, for example, over the last 2.5 decades, that it's actually on an annualized basis, even when you include dividends, it's actually outperformed the S&P 500, which is sort of a head scratcher, right? Because let's be honest, gold's a rock on a shelf, and all these companies in the S&P have earnings and they pay dividends and they have growth and all these things, but yet this is happening. And I think you're kind of touching on that right now, that there is a shift happening. And I guess the next question would be then, is it an all or none for a lot of these parts of the world where they're like, we're either going to depend on the US dollar and we're going to use it as our reserve, or we're not? Or are you seeing more of a combination? Like, yeah, we're still going to have some US dollar, we're going to have some gold, we're maybe going to do something else with our own currency. Like, what's your research telling you? Is it black and white, or is it just a lot of shades of gray right now?
Well, it's more a combination, as you alluded to. You can't not do business with the U.S. market. Okay, it's the largest market on the planet. We are the consumer of the goods that the rest of the world produces and the natural resources that the rest of the world produces. Okay, we are the end market. We're the richest country in the world by orders of magnitude. And to your earlier point about gold, yeah, gold has outperformed the S&P 500 for the last 25 years. In fact, since January 1st, 1999. We look at 5 main asset classes. We've looked at U.S. equities defined by the S&P 500 versus gold, versus REITs, versus bonds, versus T-bill, also versus commodities at large, broader commodities. And gold has outperformed all of those assets, but not by a small margin, by a wide margin. In fact, U.S. equities are a distant third in terms of total return over that period of time. And so, I would look at one of the big problems with the U.S. market for corporate stocks and bonds is the problem is it generates its profits in U.S. dollars. And that dollar value is just continuing to plummet over time relative to the value of gold. And gold is, as you put it earlier, a rock in the middle of the room, right? And everything else is just relative to the value of that rock. The rock isn't really going up in value so much as everything else is going down.
The more I look at it and the more I talk to people like yourselves, what you just said, I think, is spot on, that gold's a relative asset. It sort of sits in the middle of the room, and then everything else sort of moves around it, and the values go up and down, and gold simply reflects those values. So yes, gold's going up. Doesn't mean you need to run to the hills, but it should have your attention on why is that the case. And also the last 25 plus years, I think it's interesting. So many people, their biggest objection when we talk about gold is that it doesn't do anything. It doesn't have a dividend, it doesn't have earnings. And what do you say to an investor when they say, well, why would I invest in gold? It doesn't do anything. What's your kind of standard response to that? How would you get people to rethink that allocation?
Well, the most important fundamental in any investment scenario is supply and demand. The problem with gold is it's a very limited supply. And the demand is growing at a geometric rate right now. And the reason that demand is growing is because of this central bank put that I would describe. If in fact this is correct, and I believe it is, that the trend toward gold as a percent of central bank reserve assets is slated to increase and probably double over the next 25 years, that I think there's going to be a steady bid for gold from the investment community who wants to participate in that. Okay, because just like, for example, Bitcoin, okay, there's a limited supply, and supply and demand is going to favor holding that because only a certain amount can be produced at any given point in time. And, with respect to gold, if you don't really want to invest in the rock itself, you can invest in the companies that are mining gold. Think about this. If you're a fundamental investor, what you're really looking for is highly profitable companies, right? Companies that have extraordinary gross margins that are sustainable. Well, if the price of gold is going to steadily increase because of that limited supply and fundamental demand that underscores it, then what you have right now is you have an industry of the top mining companies that have relatively fixed all-in sustaining costs to mining that every ounce of gold, right? And that level right now is around $1,500 to $1,600 for the top 50 North American gold miners. That's your all-in sustaining cost of pulling an ounce of gold out of the ground. Well, you can sell that ounce of gold today for $4,200 in the futures market, okay? What's the profit margin on that? Nearly 170%. So, a lot can happen when we're talking about commodity prices and supply and demand and all the things that kind of interfere with that. But one thing that isn't going to change is they're not going to invent a machine tomorrow that can manufacture more gold out of nothing or mine more gold out of an environmentally difficult sort of process at a much higher rate of change than they're currently doing today. The country that mines the most gold today is China. They are the biggest producer, and they are consuming every ounce that they produce themselves for central bank purposes. So I just don't see a lot of supply coming on the market.
Yeah, I always see it's about 1 or 2% a year given the current outstanding ounces. But I want to shift to maybe some other opportunities. You'd mentioned looking at gold relative to other commodities. And what other areas are getting your interest right now?
Gold's little brother is silver. And what happens is all the trends that have been developing within gold are starting to proliferate within the rest of the precious metals complex. And what we're seeing is the general public is accumulating silver in a big way, and that there is a shortage of physical silver to deliver into that demand. And what we're finding is that is driving the price of silver up at a much faster rate. For example, year to date, price of silver is up almost 75% or so. Just year to date. That's outstripping gold, which is up over 50% year to date. Silver, relative to gold, is still very, very cheap. We look at this long-term ratio that goes back over 50 years, and we look at the price of silver priced in gold, right? The gold to silver ratio. And that ratio, when it gets above, say, 100, tends to indicate that silver is very, very cheap. And when it gets down to around, say, 40, well, that's where silver's a little bit richer. It's a little more expensive. Well, earlier in the year, we saw this relationship peak at about 110, 112 or so, whether you're looking at closing or intraday data. And it peaked there and it's declined dramatically. We're down in kind of the mid 80s now, that ratio. Well, the median ratio was about 64. And so we're still trading at about a 20% premium to the median, but these swings are very, very dramatic above and below. And so, to get down into kind of the 40 level wouldn't be unusual. That would be the lower boundary of a parallel trend channel that dates back some 50 years. At the end of the third quarter, we posted a new quarterly high above $48. And I think that was an important feather in the cap of silver right then and there, because quarterly closing prices are more important than monthly closing, weekly closing, and daily closing. But we posted a daily close above $51 the other day, and that definitively resolves the pattern with a new all-time closing high. It's my opinion that we will continue to see this uptrend in the price of silver accelerate from here at a steeper angle of ascent. And probably see this relationship between gold and silver move from where it topped around 112 or so down to a low of around 40, which just comes in at the lower boundary of that parallel trend channel.
Is there any other kind of topic or theme or idea that you'd want to leave the listeners with before we sign off?
I would just talk about risk management a little bit. Managing your position size is the first line of defense in risk management. So many people get a great idea, and it is a great idea, right? And it ultimately works, but they take too big of a position size initially, and they've bitten off more than they can chew, Ed. And as a result, when volatility eventually and inevitably enters the market and enters that trade, they don't have the wherewithal to stand through it.
I think the concept of managing position size is critical. I mean, you hear it all the time. Someone retires from a major corporation and 70% of their net worth is in this stock. And it's the hardest thing for them to do because they've put their life and soul into a company for 4 decades or more sometimes, to sell some of that down because they feel like they're doing the company a disservice. But the reality is, you're 100% right on a risk management standpoint. Managing your position sizes and staying committed to those position sizes is really key. And all too often, myself included, when things are working, you really don't want to sell them because it's really fun when you see it keep going up. But it becomes too overweight, and you got to have that discipline. And conversely, something you love that maybe is not doing as well as you thought, you got to have that discipline and get it back to that weight in your portfolio. So that's really well said. Managing position size is certainly key. I would agree with that. Well, Jeff, it was great to have you on. I really enjoyed meeting you last week in Minneapolis and hearing your comments on that panel. Thanks again for taking the time today.
Absolutely. Thank you so much for having me on the podcast today. It was a pleasure meeting you as well.
Yeah, my pleasure. And once again, my name is Ed Coyne, and thank you all for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.